Recording.
Perfect.
Judy, you can take it away.
Thank you. So, hi everyone, welcome to our today's ADP presentation session. So I'm your moderator for today, Shuting Wu, and thank you for joining us. And to ensure a smooth experience, please mute your microphone to minimize the background noise. But we encourage everyone to share the video, so it will help us to engage more with everyone. And if you'd like to ask a question or make a comment, feel free to raise your hand or type it into the chat box or use the hand feature function. I'll call on participants in the order I see them. So before we begin, I would like to remind you that our presenter will have first slide and last slide uninterrupted. And so now let's welcome our presenter. So today we will have Federico present his paper titled Re-standardized Financial Statement Data. So floor is yours, Federico.
Well, thank you very much, Shuting, for the introduction. My name is Federico Siano. I'm an assistant professor at UT Dallas. So let me start sharing my screen to make sure that everyone can see my presentation. If you cannot, just let me know. And I'm gonna utilize the full screen mode. There we go. So you should be able to see in full screen mode my presentation. If not, please let me know. Thank you to the organizers for having me and for the opportunity to present my research today. This research paper is co-authored with Matt Lyle and Terry Yon at Emory University. So let's jump into it. We all utilize CompuStat financial statement data in our research. In fact, I cannot think of any of my papers that does not employ the North America Fundamentals annual and quarterly files. Now, I don't know if you know, and I don't know to what extent you know, that these products are repeatedly updated and standardized. Restandardization implies that the data within the CompuStat files is continuously and repeatedly overwritten. And this can generate issues with respect to, number one, replicability, and number two, look-ahead bias. Therefore, in this paper, we utilize point-in-time data to essentially examine and investigate on a large scale restandardizations. And in particular, we analyze the type, the frequency, and the magnitude of restandardizations, and whether they can impact results. Overall, our objective is to examine a potential issue when utilizing financial statement data and to offer potential solutions. This issue has implications, of course, for researchers, but also for policy makers, because academic research is utilized and leveraged, for example, by standard setters such as FASB. And I will talk more about this issue later in the presentation. All right, so how do we think about restandardizations? It is not extremely easy to answer to this question. And so let me begin with our interaction and correspondence with S&P Global as of July 2024. Essentially, we asked them, how should we think about restandardizations? And they told us that the CompuStat North America data is standardized to enhance comparability. Because despite common FASB standards and SEC regulations, there is substantial heterogeneity in disclosure and reporting practices within firm over time and across firms at any point in time. And therefore, CompuStat essentially adds value to their clients, which we have to remember are primarily non-academic, by making the data, the financial statement data, more comparable and removing this reporting variability. Now, from this type of answer that we got, we don't fully understand really what restandardizations are. We definitely understand that restandardizations try to enhance comparability and that this is how, or one of the ways through which CompuStat adds value to their clients. But I will show you examples and I will walk you through case studies to try and make this process a little clearer. So please stay with me. I would like to first discuss briefly the different types of CompuStat products that are offered and what we use in this paper, and then I will talk about the examples. So CompuStat essentially offers three types of products. The common products, which are the ones that we usually employ, where data is updated and re-standardized, and history is continuously rewritten. So if I keep constant the firm and reporting period, the data that I download for that firm and fiscal period today could be different from the data that I download tomorrow. Then we have the snapshot, unrestated, and restated products within the CompuStat universe. Even the unrestated product is adjusted. So unrestated does not imply lack of standardization. And then we have the restated product, where this is essentially the most recently re-standardized financial statement data. And finally, there is snapshot point in time, which is what we use in this paper, where unlike the common products, the data is not overwritten. And therefore, the newly standardized data points are appended to the prior standardized data points. What S&P Global does in terms of the timeline is when a company files an 8K, including a press release that contains some financial statement information, S&P Global collects this information and adds a record to CompuStat on a preliminary basis. Then when the company files a 10Q or a 10K with the SEC, S&P Global updates the record on a final basis. Regardless of whether the data is collected on a preliminary or a final basis, the data is standardized before it is provided to the clients. So now let's look at some examples. The first example that I would like to discuss is this quarterly example for General Electric. And here we are in panel A, reporting the S-file data that we collected manually from the regulatory filings for the third fiscal quarter of 2015. And then the panel B includes the point-in-time data, okay? So you can see what happens. In October 2015, General Electric files an 8K that includes a press release and also includes some financial statement data. On the same date, CompuStat adds a record to its data files. The data is reported on a preliminary basis. UPDQ is equal to 2, meaning it's preliminary. And the SRCQ code is equal to 21, meaning that the document source code is preliminary. Then in November, GE files a 10Q report with the SEC, including financial statement data. And the day after, CompuStat updates the prior data point on a final basis now, UPDQ is equal to 3, and the SRCQ code is equal to 5, meaning that this data is coming from a final document source type. Now, you can see what happens between November 2015 and November 2016. The data keeps changing. And here we are just looking at a selection of financial statement items. We could have looked at many more. So for example, we have changes and substantial changes in quarterly sales. We have changes in income before extraordinary items, which is one of the most widely utilized variables in our research. And in this case, the change is up to approximately 70% in absolute percentage terms. We have changes in operating income after depreciation. We have changes in special items, and we have some changes also with respect to the cost of goods sold. So we believe that these changes are fairly sizable and frequent. And so then the next question that we asked ourselves was, well, maybe this is not CompuStat. Maybe it's the company restating its data, its financial statement data. So we started by looking at all the regulatory filings that the company files with the SEC from November 15 to November 16, and we couldn't find any amendments. So we don't have a clear indication of financial restatements. Now, this does not imply that the company did not do any financial restatements, because there could be other types of restatements that are not included in amendments, which is why we then ran a very restrictive analysis excluding all the possible financial restatements, and I will show you evidence of these results. I want to show you also an annual example for Boeing. Again, S-file data versus point in time. January 2017, the company files an 8K, including a press release, and on the same date, CompuStat adds a record on a preliminary basis to the annual files. Notice that even for this initial data, the data that Compustat adds to its files is not identical to the S file. And so there is a change, there is a difference in operating income after depreciation. We couldn't identify special items in the press release, but Compustat added special items, and the cost of goods sold is slightly different. Then in February, the company files a 10K, and 3 days after, Compustat updates on a final basis this data point, and then the data changes for the next couple of years. And in particular, we have changes for operating income after depreciation and special items between 15 and 50% in absolute percentage terms. And we also have some changes for the cost of goods sold. Okay. Again, we look at amendments. We found an amendment for Boeing, but it was about the Iran Threat Reduction and Syria Human Rights Act. So we couldn't identify evidence of a financial restatement. Again, I will show you a very restrictive analysis on financial restatements using a stepwise approach to make sure that we're not simply capturing financial restatements, okay? Yes, please, Young.
So I would like to ask you a question about the Boeing example you gave us. So when you say SE file, right? My experience of kind of collecting that information is sometimes we also encounter this disagreement with Compustat number, because it's not necessarily directly coming from the financial statements. They also went into footnote disclosures or any part of the 10K or 8K or 10Q. And sometimes the sentence can be a little bit ambiguous. So I think there's some discussion actually were exercised by them or by us to come up with those numbers. So how do you address that issue? Is actually the nature of the disclosure is ambiguous. That is very likely two financial experts or two CPAs will actually come up with different numbers for this company and this year.
Yeah, this is an excellent point. So let me explain you that, the reason for why I am comparing the S-file data with the point-in-time data is to make the point that even when Compustat originally adds a record to the annual file, essentially restandardizes the data. We are not really concerned about the difference between the S-file data and the Compustat data. We are trying to compare Compustat with Compustat, right? So we are trying to make the point that there is an ongoing process of overwriting for the same Compustat data. So for the same Compustat data, the judgmental process is kept constant. There is no judgment there, or it should be constant, right? It could be the case that maybe Compustat is changing some of its methodological choices. We don't know really, but the point that we're trying to make is this ongoing updating of the Compustat data. We're not really trying to compare the S-file data with the Compustat data. I was making this comparison to show you that there is a difference even for the S-file data. And maybe the difference has to do exactly with what you were saying before, that there is some judgment associated with the type of numbers we can extract from the regulatory filings. Now, I have to say that especially for this data point, which is about a press release that is included in an 8K, I read the press release. Clearly, the level of disclosure that is included in the press release is still sizable, but not as sizable as, for example, the disclosure you can find in a 10K, right? And so here, the additional information that you could find that may help you identify certain data points, such as special item, is slightly more limited, right? And so maybe in this particular case, it's not very much an issue, but the judgment and the interpretation and the disagreement can definitely play a role for the 10K record. Sudipta?
Yeah, so S&P, by virtue of being a bond rating agency, has preferred access to data from companies, right? And so then the question of the special items might be that they specifically ask companies for information beyond what's in the financial statements, even after the 10K. they sort of this thing. And then, of course, there may be events afterwards, say like a merger of the pooling, because that doesn't happen today. But back in the past, you'd have to restate, or you might divest a business or whatever, and you'd have to restate to keep them consistent and so on. So just wondering what processes could be going on in the background.
Yeah, this is an excellent point. I very much love what you're saying about this preferential access to and potentially, one-to-one communication with the corporations. You're absolutely right. Maybe the reason for why they were able to fill in this special item record was because they talked to the company. Again, the point that we're trying to make is mostly about this level of change within the CompuStat data, right? And so for this level of change, clearly there could be firm level events that might explain why we observe this change. There could also be methodological practices that are within CompuStat that explain why we observe this change. We cannot really, and this is a little tricky, but we cannot really reverse engineering because it's very complex, the function that CompuStat utilizes to restandardize the data. But we are trying to observe essentially the frequency and the magnitude of these ongoing restandardizations. And we're trying to make the point that these restandardizations can make replicability a challenge very much as inject look-ahead bias in the empirical samples. But as far as the drivers of the change, I totally agree with you that the ones that you are highlighting could well be some of the drivers for these changes. It's just that it's not that straightforward on a large scale to identify exactly what CompuStat is doing. And obviously, this is how CompuStat is adding value to their clients. And so probably it's pointless to ask them because clearly this is proprietary information.
So we don't know, for example, for COGS that they extract the depreciation and add it to the other depreciation because they want to have all the depreciation together. They're looking at the depreciation accounts or the asset accounts to figure that out. So some of this difference is coming from that. Sort of because that's what they do. And then other stuff, they might be reporting because it wasn't considered individually material, but in aggregate, whatever. So anyway.
No, I totally agree. I totally agree. And this goes to the, to the question of what is really the process behind restandardizations. And I want to be clear on this because I am very much curious about it as well, to be honest with you. And I think it's a very interesting aspect of this data. I want to say that as of right now, our paper is not really dealing with this particular aspect. We're not really trying to understand how exactly the restandardization takes place. We're trying to exclude the possibility that most of these restandardizations come from financial restatements, and I will show you what we do about it. But we're not trying to fully understand how the process works because the point we're making is a little narrower, if you want, and is about how the ongoing overriding may affect replicability and potential look-ahead bias. But I agree that maybe what you're highlighting could be an avenue for an additional paper to try and understand how the process exactly works. Joshua?
So just a little bit of inside information about how things work at CompuStat. They essentially received the press release from the company, and immediately they say within 3 days, they would put it into their database. And a lot of times, the press release is limited in terms of the information. And if, for example, depreciation was not in the press release, they would not make the adjustment to cost of goods sold that you see here. They pride themselves on reflecting the information immediately in the database for S&P 500 companies within 1 day, for most companies with 3 days. But I wouldn't count on that as really rigid timelines. As far as your statement about restatements in the data, notice that CompuStat boasts that it does not change the annual data. The only data that is being rewritten, as you said, is quarterly. That's what they claim. In fact, you may find also annual data to be restated, but for the most part, the restatements occur in quarterly data, and they occur because primarily mergers and acquisitions and divestitures. So when a firm issues a quarterly report 2, 3 quarters, sometimes 7 quarters afterwards, and they provide the comparable numbers from the prior periods, CompuStat is going to take those and put them into the database. So the problem is more severe for quarterly reports, not for annual reports.
Yes, this is an excellent point, and I want to reiterate what you're saying, because as I was analyzing the data, I noticed that the level of variation and the frequency of the restandardizations is much higher for the quarterly data. And so I asked S&P Global whether this restandardization process would affect the quarterly data differently from the annual data. And they told us that yes, the restandardization phenomenon is more pronounced for the quarterly data, because very much as Joshua was alluding to before, the annual data is substantially non-standardized, but they didn't really provide many details about this. So this is the only type of information we were able to obtain from them, that there is a different level of variation induced by restandardizations for the quarterly versus the annual file. So I think Jung, Sudipta, and Stephen.
I just have a minor point about your response to us earlier. It sounds like we don't really know the ground truth, what exactly is the right number, right? So when you say those will be biases, it's hard to kind of judge what the bias is when we don't have a benchmark that what is actually the true number. So I'm going to wait and then see how you kind of like elaborate on how do you demonstrate it's actually bias or look ahead in your subsequent analysis. Yeah.
Yeah. So, I guess, so I was talking about the bias primarily when I was referring to the look ahead bias, right? And so there, you can argue the following, that if you make an assumption, right? Because to some extent, if we agree that we need to rely on some data provider for financial statement data, right? We can make the assumption that maybe this originally provided, or let's say for this final one, okay? So this final data point that is provided by CompuStat is essentially, or can be thought of as the information that, for example, investors had available when this particular filing was filed with the SEC. The look-ahead bias kicks in because then if you change this data and you utilize at a future point in time a different data point, for example, for operating income after depreciation, and you try to correlate this with a market reaction, then this data point here was not available when the 10K was filed. So if you assume that this is the information that investors had access to, then basically the look-ahead bias kicks in because you may be utilizing at a future point in time data that is not the one that the investors had access to. Now, if you think that there is an issue associated with how CompuStat originally writes the data points, I can agree with you that there is an additional issue, right? This is to some extent an additional problem, that there may be some interpretation going on here with respect to the financial statement numbers, and there may be some potential inconsistencies with the S-file data. Okay. Sudipta.
Yeah, so as part of the annual audit, they look into things that are estimates, say LIFO estimates are updated at the end of the year under the integral reporting system.
Mm-hmm.
So you can go back to DeFond and Giambalvo, I think it was 1990. They look at quarterly restatements of quarterly numbers by companies. And so there's a bunch of things where we do estimates, but they're settled up at the year end. And so that's going to create rewriting of the quarterly data. But from sort of an investment strategist point of view, they don't care about what was announced at that date. So in that sense, CompuStat is providing the data they need for estimating trends or whatever in a more comparable manner, I think. So.
No, I see your point. In our data, we find, for example, I have a couple of comments, follow-up comments on your observation. In our data, we find that, for example, restandardizations on average keep taking place for a couple of years after the data point is originally included within the data files. So it's a phenomenon that seems to be slightly longer than just the year-end type timeline. The other aspect that I would like to highlight is that we are very agnostic about whether one should utilize standardized data or non-standardized data or point-in-time data. We are agnostic because obviously these data files and these different types of data sets may serve different purposes, right? So if I put myself in the shoes of a financial professional, which I used to be before joining academia, I would be very happy to utilize restandardized data, especially for forecasting purposes, because I want to have the most updated data possible, right? I don't want to have stale data. But if I do, rather than forecasting, backcasting, right, then maybe there I may want to be aware of the possibility that the data that I'm using has been changed, right? So I think it's important to highlight that we're not making any claims about what is the data that should be utilized. Different data will serve different purposes. Stephen.
Yes, to bring back some memories here. Years ago, I think it was about 1979, they were restating the annual file, and that was important because of pooling at that time, okay? And I actually contacted them, and they prepared for me an as-reported file, okay? And then going forward, I've learned to believe that the annual file is the as-reported file. We've all known that the quarterly one has a lot of statements. So my question is, you've got the as-reported file, and you've got this snapshot file, right? Which I'd not heard of. Do you see differences between those two files, which are severe?
Yes. So let me ask you a follow-up question just to make sure that I understand your point. You're saying that CompuStat offers unrestated files, right? That's what you're saying.
They call them as reported files.
Yes. So yes. So
annual. I'm talking annual.
Yeah. Annual. So this is basically what I was talking about before, right? The unrestated, right? Yeah. So it's an excellent point, and I was surprised about it. But yes, there are differences between the point in time and the unrestated. And to be entirely honest with you, I don't know why.
Yeah, that's a question. Yeah.
There are differences between unrestated, which is what they say would be the untouched, right? The S-filed data. There are differences between unrestated and point in time. I asked the question explicitly. So if you don't mind, I'm going to jump at the end of the presentation where I have our correspondence with S&P Global. And I asked this question. I said, does the unrestated file contain the first record from the point in time file, right? And the restated retained the most recent or last record, which is what one would expect. And they said, in recent years, you can align point in time to the initial reporting. But at other points in deep history for the point in time database, The snapshots were monthly and weekly. So, I don't fully understand, right? So it's not that straightforward to make that connection, okay?
Yeah,
but it's an excellent point, yes. So I think Peter was next, and then Joshua.
Hi, Federico. Thank you.
Hi.
This is interesting. Just a quick question, because I was taking a quick dip into some of these filings for Boeing. So at the top there in the as filed data, I mean, have you considered the fact that there may be inferences being made from the filing? For example, the cost of goods sold figure of 8790 is not reported in the 8K on that date. What is reported is a profit margin of 9.4%, which might be subject to some rounding errors. And then when you get to the 10K, there's more detail provided. So, they provide they report the 8790, which actually includes capital interest expense, but also cost of products and cost of services. So the point is that the inconsistency between the early 8K filing and the 10K filing could be A, due to estimation error by Compustat, or B, just definitional discrepancies between what's required in the 8K and what comes into the in the 10K and what comes into the 8K.
I absolutely agree with you. It is very much possible that essentially Compustat is learning about information that was originally reported or filed with the SEC through subsequent filings, or that there is estimation error, or that there are additional drivers explaining why there are inconsistencies. What I was explaining before is that the point that we're trying to make here is we are not really trying to understand or reverse engineering the function that Compustat is utilizing for these types of risk standardizations. We're trying to highlight the existence of this phenomenon, this ongoing overriding of data, which can impact replicability and inferences because of look-ahead bias. Now, we're not, we believe that it would be a little complex on a large scale to understand what exactly is going on in the data. It is absolutely possible that interpretations, that information gathered from subsequent filings, that errors are explaining or driving what's going on here. What we're doing in the data is we try to exclude the possibility that these restandardizations are primarily driven by financial restatements. And I will show you some analysis on this. The other aspect that I would like to make is when I will go and show you the results, I will show you that we ran the analysis in many different forms. For example, we compare data, point-in-time data within document source type. Imagine running an analysis that looks at the changes across consecutive point-in-time updates for the same type of document. So this would be a 10K. And Compustat would change for the same 10K the data. And maybe Compustat is changing the data because it's learning about some of the past data from a subsequent 10K or a subsequent filing. This is absolutely possible. We don't really dig deeper into this aspect because it's a little complex. We think it would be pointless to ask Compustat because this is how they add value to their clients. So probably it's proprietary information. And our point is a different one. We're trying to highlight this ongoing overriding and how this ongoing overriding could be frequent and sizable, and whether it can have any implications for research. Christina. there was a question
Apologies.
maybe?
I mean, it was a mistake. Sorry about that.
That's fine. Okay, so let me try and talk about some descriptive statistics. So what do we find? So if we keep, so here we're looking at the quarterly snapshot file, okay? We ran the same analysis for the annual. We will update the paper shortly because I've run additional analysis, of course. But as an example, looking at the CompuStat snapshot quarterly, we find that keeping constant the same firm, fiscal quarter, and fiscal year, we have on average 6 updates, okay? So there are 6 overwritten records for the same fiscal year, fiscal quarter, and company. And the data continues to be re-standardized for on average a couple of years, okay? Then we analyze the type, frequency, and the magnitude of the updates. Let me talk about this. So first of all, we find different types of updates. We find financial statement analysis items changes numeric to numeric, missing value to numeric, or numeric to missing value. When we look at the numeric to numeric changes, which are probably the most interesting ones, we find that for approximately 1/3 of the sample, so 35% of the sample, has at least one financial statement analysis item that varies across between consecutive point-in-time updates in a numeric to numeric fashion. So from a number to another number. So the frequency is pretty sizable. And we run this analysis in 2 different ways: across document source type and within document source type. So going back to Peter's point before, we compare both, for example, a 10K with a press release, which would be the across document source type analysis, but we also run the analysis within the same document type. So 10K with 10K, 10Q with 10Q, press release with press release. And again, here we find that 26% of the 26% of the entire point-in-time sample that exhibits at least one financial statement item varying between consecutive point-in-time updates. When it comes to the magnitude is fairly sizable. We find that on average, the absolute percentage change is 65% for the numeric to numeric change, okay? So it's a fairly sizable magnitude in our opinion. When we look at the type of financial statement analysis items that vary the most, we find, for example, that special items, PP&E, net income, inventory, IBQ vary on average by 100%. And then we have long-term debt, cost of goods sold, sales, SG&A, total assets. They vary substantially, but less, between 5% for total assets, which is pretty sizable still, and 45% approximately for long-term debt on average. Then we look at changes in earnings and sales, because of course in our literature, we utilize changes in quarterly earnings as a measure of reported earnings news. And here we look at changes in IBQ, changes in net income, and changes in quarterly sales, assuming a seasonal random walk model. And we find that conditional on there being a change, the magnitude of the change is 100%. And in 10%, on average 10% of these cases, the sign of the earnings change switches from being negative to positive or positive to negative, meaning that basically that variable is moving from signaling good news to bad news. Now, let me talk about financial restatements, what I was talking about before. We employ a stepwise approach, an increasingly restrictive stepwise approach, to make sure that we are not simply capturing financial restatements. To begin with, we match our sample with audit analytics, and we exclude all the material and immaterial financial restatements. The sample goes from 8.5 million observations to approximately 8 million observations. The magnitude of the change is almost identical. Next, we exclude all the unique companies that we found in audit analytics. All the unique firm, regardless of whether in audit analytics they are restating or not, okay? We exclude the unique companies because we think, well, maybe there is a firm level factor that is explaining why there is a restandardization in Compustat, which sometimes shows up in audit analytics and sometimes it doesn't. So let's exclude all the unique companies in audit analytics. The sample goes from 8.5 millions to 5 millions. And the magnitude of the change is higher than in the original full sample. And then we exclude all the companies, all the unique companies that at least once in our sample, in the quarterly point-in-time sample, have an SRCQ equal to 8. SRCQ equal to 8 means that the company is filing an amendment. We exclude all the unique companies that at any point in time file an amendment. And we find, again, a comparable magnitude of the effect. So we conclude that financial restatements are unlikely to be the primary driver of the phenomenon that we are documenting. So then we ask, can this impact results? What do? We fix the time of when we collect the initial data, okay? We fix the sample, and we employ a forward rolling window approach, and we reassess the same sample at future points in time dates. So for example, we fixed our sample.
Federico, we have one question from Sudipta asking, did you examine prior period adjustment that don't rise to the level of restatements?
Prior period adjustments that do not rise to the level even of a minor restatement. Probably not. I don't know how exactly I could capture those, to be honest. So we didn't really look at adjustments that do not involve restatements. But what we do is, to some extent, if you think that adjustments are more likely to happen, the adjustments that do not turn into restatements are more likely to happen for companies that are included in audit analytics, or for companies that at any point in time file an amendment. To some extent, we take care of that in these two types of analysis, right? Okay, so so this is our empirical strategy. So we fixed our sample in 1995, for example, and let's say June 30th of 1995. We download all the data available, and for this year, and we basically keep the sample constant and reassess the sample at future point in time dates. And we repeat the same for an initial sample formed in 1996, 1997, and so on and so forth. What do we examine? 3 things. To begin with, we analyze the quarterly data. So we analyze regression coefficients and edge portfolio returns around quarterly earnings announcements. Then we look at the annual data, and we analyze edge portfolio returns based on accruals following the Sloan 1996 trading strategy, and the accruals, cash flows, negative correlation over time following the Bushman et al. 2016 analysis, again, using annual data. So 1 quarterly based analysis and 2 annual based analysis. Let's look at quarterly ERCs. So if we fix our sample in 1996, and we basically reassess the same observations at future point in time dates, we find that the regression coefficient obtained from regressing the short window market reaction around earnings announcements on the change in IBQ, assuming a seasonal random walk model. So the differences in the ERC go from a minimum of 8 to a maximum of 10. So it's approximately 20%. In terms of T statistics, the difference is much higher, going from a minimum of 7 to a maximum of 12. So it's approximately a 70% difference. We find sizable variation also between 96 and 98, in 2001 and 2004. And then for the other years, the variation is less pronounced. Then we look at quarterly edge portfolio returns. And so we divide our companies into high and low earnings changes. And we assume that we are essentially going long in the companies with high earnings changes and short on the companies with low earnings changes, based on quintiles and deciles. And we look at changes in the profitability of this trading strategy across point-in-time updates. For the sample formed in 1995, the difference in annualized terms is 27%. So it's a very sizable difference in annualized terms in terms of return from this trading strategy. In 1996 is 21%. In 2005 is 15%. And we find equally sizable magnitudes looking at other years. So basically, the assignment to portfolios changes at different points in time dates. And this generates sizable differences in returns. Then we look at annual hedge portfolio returns based on accruals. We calculate accruals in different ways. We look at future 12-month abnormal stock returns. So we go long in the low accrual, short in the high accrual. As of 1996, we find an average. So we find a difference between the maximum and the minimum relative to the mean of 7%. In 1996, 13%. In 2000, 33%. And again, we find equally sizable differences for other years. Next, we look at the correlation between annual accruals and cash flows. So this is the ranked correlation between annual accruals and cash flows, fixing the sample in 1998 up until 2022. And so this is a new analysis that is not included in the paper yet. And we look at the difference, for example, between the maximum and the minimum negative correlations across point-in-time dates. And relative to the mean here, we find a 26% difference for 1988. In 2013, the difference is 97%. And you can see that these differences can be very, very sizable. Now, one point that I would like to make, as you can see from this evidence, is that the effect size of this particular phenomenon varies depending upon the task and the time period, which is one of the points that we're making. Replicability is complicated in this case, and we don't know exactly what the effect will be, because the effect size will vary depending upon the specific task and time period. So I would like to briefly talk about the positioning of the paper relative to prior literature. I think our paper complements two prior streams of the literature. One that looks at how popular data providers regularly modify their products, such as IBIS or Refinitiv ESG. And the other stream of the research that looks at how data providers make methodological choices and sometimes change their methodological choices in the data collection process. We complement these two streams of the research by focusing on Compustat and showing and examining the magnitude and the frequency and the impact of this data, of this ongoing data overriding process. Now, we think that there are implications for researchers coming from our paper. We show in this paper that restandardizations are frequent and large. And the point that I was highlighting before, we also showed that the effect size will vary. It's time varying, and it's also context specific. Therefore, replicability may be challenging to achieve because keeping the same data point constant, the specific financial statement items may vary depending upon when the data is downloaded. And at the same time, restandardizations may inject look-ahead bias in the sample because obviously, if we look at, for example, the market reaction to financial statement data, there may be some data points that were not available to investors at the time or that have changed over time at the time of the initial regulatory filing, and therefore this creates potential look-ahead bias. But we think that there are also implications coming from our research for policymakers. And the reason is as follows. Regulators and standard setters utilize accounting research for their decision-making. For example, the FASB has been seeking postdoctoral fellows over the past few years to try and integrate research into practice. And the differences in Compustat data at different points in time can potentially become material because they may impact the effect, the size of the effects being documented. And the effect size is one of the aspects that regulators and policymakers take into account and consideration when evaluating the trade-off and the costs and benefits of policy recommendations. All right, so in conclusion, in this paper, we find substantial evidence suggesting that the restandardization of financial statement data is frequent, sizable, and can result in significant variation of financial statement data items over time. The general implication for researchers is that the precise replication of prior findings may be challenging to achieve, and that restandardization may also induce look-ahead bias in the empirical tests. Young, yeah.
Okay, since you have time,
Yes.
I have two questions. So in macroeconomics, GDP has two different type of data sets. One is a real-time GDP, the other one is a final version. Because as time goes by, some of the estimates will keep being updated, right? So do you know when CompuStat offer this data that most people use, the common product, do they have a real-time version in mind, or they want to actually provide the most finalized number at a given point in time? Because
Yeah, so
look-ahead bias is assuming that they are going to offer a real-time data that is available to investors, but I'm not sure that's kind of like a stated objective by CompuStat.
Yeah.
So like you talk to them, so I want to hear that. What's your conversation with them? Yeah.
Yeah. So basically, so the CompuStat data that we normally utilize, which belongs to the category of the common products, is such that if I today download data from CompuStat, okay, I am going to get the essentially last standardized data, the latest data in terms of standardizations, right? So when you talk about real time, what I would say is you would get the real time data that investors would have, to some extent, would have had access to only for the first point in time record. When you download data for the common products using, for example, a normal words type interface, you are essentially downloading the last restated data, right? You get access to the real-time data that investors had access to only if you download the data when CompuStat essentially adds the first record for that particular firm quarter, right? So we essentially don't get to see the real-time data in the normal CompuStat products.
Okay.
Joshua?
So I apologize that I skipped before. I went through surgery last week, and in the middle of the presentation, your presentation, a nurse came to take off the bandages of the incision. So my apologies, I did not hear almost most of what you said. I just wanted to provide you a little bit more background about what these products are and why there are differences. So you were absolutely right about the common products, the way they were. And there was a company that helped CompuStat go from 9mm tapes to desktops. And what the owner of that company did was it helped CompuStat streamline the process, and that way they could weekly send a CD-ROM to companies that subscribe to CompuStat, and that person actually collected all the CD-ROMs. And he had the ability in his contract to create a database which became the first reported and also the restated the unrestated data, etc. This was called Charter Oak. And that was the first point in time database He ran into some disagreements with CompuStat about he wanted to do it also for annual data and other things. And at some point, he sold his company to somebody else. And that other company also had some issues. And at some point, Snapshot came into existence. And Snapshot is essentially the same thing that he was trying to do from CD-ROMs, the CompuStat did using their own databases. And that's why, and that started a little later, and that's why there are differences in the Snapshot and the other files that were created earlier by him, by Charter Oak. So if you, and of course, CompuStat would never tell you that. So this is something that I became familiar with because I worked with Charter Oak data. One thing that you need to realize is that as a quantitative investor, one of the things you do is you don't start a new signal before you backtest it. And for backtesting the signal, if the signal is based on historical data, then you need to use the data as was available at that point in time. So we actually, when I worked in industry, we actually retained first the Charter Oak data and then the snapshot data, the point in time data, because that is the basis for everything that you do. So say you want to look at tax expense at a particular point in time, of course, on a quarterly basis. So of course you want to use the snapshot data for that and come up with your strategy, etc. There are slight differences also because of the immediate updating, what you called preliminary and final, and that's a different issue. But that most people would not use the preliminary data, but use the final data in their investment models or even in their backtest. So just a couple of points about those.
Yeah, and I actually love the historical digression that you made, because I think it gives a lot of context to how these products came to exist. One thing that I would like to add to Joshua's point is, like I said before, it is very likely the case that different products will serve different type of purposes and objectives. So in no way we're claiming that one should always utilize point-in-time data or one should always utilize the standardized data. What we are trying to highlight is that we are trying to highlight a feature of this data that may, as we utilize the data, generate issues for us as researchers, and therefore for the people utilizing our research, for example, standard setters, right? And so, in fact, if I go to the conclusions and actually our general recommendations, the point we're making is that the utilization of point-in-time data can definitely and largely resolve potential replicability problems and potential look-ahead bias, which is essentially what Joshua was alluding to before. If I want to build a strategy, I need to make sure that I'm utilizing the signal that was available to investors at that particular point in time. I don't want to utilize signals or data that has been overwritten by CompuStat that may not be available to investors at that point in time. But essentially, this utilization of point-in-time data is helpful if, and as long we believe that replicability is important in our research field, and as long as we believe that look-ahead bias could be a problem in our field. It is absolutely fine to continue utilizing restandardized financial statement data because, in fact, this could be and serve other types of objectives and may be desirable for certain type of tasks. but at least our general suggestion would be that researchers disclose the date on which the data that they are utilizing was downloaded, because this
Hi,
will make.
Sorry to interrupt. We're almost running out of time. If you would like to quickly wrap up.
Yes. This is my last point, I promise. Again, our general suggestion, even if you don't want to utilize point in time because you believe that for your particular task, the restandardized data is optimal, at least disclosing the date on which the data was downloaded may help other researchers replicating research findings. Okay, so this would be our general recommendation. One last thing, I need to announce the upcoming ADP event, which is going to take place on October 22nd in a couple of weeks. It's going to be a Tuesday, 12:30 p.m., 1:30 p.m. Eastern Time. Mark Ma from the University of Pittsburgh will talk about operating lease recognition and credit assessment by banks. It's been a pleasure. I had a lot of fun. Thank you very much for your thoughtful comments. And again, I will stay online if anybody wants to chat later. Thank you again for your participation.